Hey, welcome to the podcast, everybody. Thank you for joining me. It's September 18th. The stock market is closed for the day here on Wednesday, and the Fed surprised pretty much everybody. Not everybody, but surprised most people by not tapering today. And maybe, just maybe, we'll start to hear less of that word over the next few days and weeks. Maybe not the next few days. We'll probably hear more of it. But maybe over the next few weeks we start to hear less of it. Who knows? But the thing is, the market was clearly priced for tapering, and most believed that it would be somewhere, including myself, that we would have had a taper light, essentially meaning the Fed, which is currently buying $45 billion a month of Treasury bonds and $40 billion a month of mortgage bonds, that they would have scaled back maybe $10 billion of that, and it would have come from mostly treasuries, and it would have been done for a couple of reasons. Number one, because they said they were going to do it, essentially. Number two, that Bernanke wanted to start the process before he leaves office. And about 70% of those that were polled, economists and so forth, believed that they would start to do it this time. And 30% said they wouldn't, and those 30% were correct. And clearly, from the way the stock market reacted, people weren't positioned properly for it in the bond or the stock market. And you could see it. Gold shot up. Gold was up $60 an ounce today. The stock market was up over 1% today. Interest rates dropped. Remember, they went up to about 3%. They're now down to 2.7% on a treasury. And so here's the big jump at 1 o'clock Central Time, 2 o'clock Eastern, when the Fed said that they were not going to taper and never really gave it back. And that has a lot of implications. In the last few weeks, what we have seen is a stock market and a bond market and an economy. Well, really, the economy itself has been sending mixed signals, right? We had some really weak non-farm payrolls reports. We had housing starting to show that the interest rates, while not ruining the recovery, certainly were changing the trajectory of the housing recovery. It was starting to slow just a little bit. And so given that, the Fed didn't believe that this was time to taper. And so I thought at some point today the market would fade. I thought it would jump initially and then fade if this happened. And it never really faded. I thought it would fade for this reason. I thought it would fade because people would worry that, well, if the Fed is not tapering, certainly they're more worried about this economy, and they think things are getting really bad. And maybe they will do that in the next few days. But one thing that I didn't think would happen is that interest rates would turn around and start going back up. Interest rates went down. They got stronger as the day went on. Interest rates continued to fall. That makes sense. There's a natural buyer for treasuries and mortgages, and that's going to continue. So, we want the Fed to get out of the way, and they're not. So what we're going to see is that if you're somebody sitting in money markets and CDs, then you are going to continue to get punished at least for another year and a half at the earliest, and perhaps maybe 2.5 years. You're going to continue to earn virtually nothing on money markets, CDs, very, very short-term treasuries. The Fed's goal is to get you to do something more productive with your money via buy stocks, bonds, real estate, clothes, new iPhones, whatever the case may be. And certainly they got what they wanted today because people rushed out of those things rushed out of the money markets and CDs and into, the S&P 500. So, which is good. Over the last, the very interest rate sensitive securities that I have, the things that have been getting hit the last couple of months, rallied extremely hard today. And I wanted to play the middle with rates. I didn't want to bet that rates were going to keep going up. And I also didn't want to bet the farm that they were going to start coming back down either. But as I've been saying on the podcast, I think when you look at interest rates, and here they are, and they had gone up to about 3% on a 10-year treasury. But I had said, I don't know if the economy can withstand rates continuing to go up at this pace. And now, again, not to say I believe they're going to go back down to here, but they're going to act as a governor, right? The higher they go, the more costly it is to borrow money, and that's going to slow things down. And that's exactly what the Fed thinks is happening, and they believe that the market did a lot of the heavy lifting for them. The market raised interest rates already. So having said that, we have on the equity side at my office been buying the dips in this market. And the only reason why is because nothing else has really worked this year, right? We had a dip here, a good buy, a dip here, a buy, a dip here. Now remember, all of these were at the 50-day moving average. Then we got something in June that looked more severe, bounced off the 100-day at a much lower level. That was a good dip to buy. So then when it comes around to this one, why wouldn't you buy that one? And so we went in and bought a lot of things, a lot of individual companies, and we've been spreading it out into areas that are short certain areas, certain countries, long certain countries. We are owning individual companies that are doing very well, and a lot of those companies have been just screaming higher. And it's not necessarily in one sector. It is working really from the bottoms up and looking for companies that are exhibiting not only fundamental strength, but technical strength. And so we've actually been buying more on the equity side. We didn't buy more on the interest rate side. So those things have performed very well in the last few days. But those are the same things that got hurt in the prior few months. So over net, all in all, this was a very good day for those people, including myself, that owned gold, owned stocks, owned some interest-sensitive items, and pretty much big gains across the board on really everything on my screen. The people that got hurt would be people that thought the Fed would taper more. They thought the Fed would say, hey, we're not only going to stop doing the $85 billion, we're going to cut it down and maybe do $60 billion a month. You would have seen interest rates rise. You would have seen gold fall. You would have seen stocks fall. And so there's a lot of people who probably got hurt thinking that was going to happen and bet that way. But that's not what happened. Now, I do want to point out something on this chart. So, and this kind of struck me today, but if you look at this, you know, the 50-day moving average, let me draw that in red. The 50-day moving average, which is this blue line here, was support for the market. Now it's the 100-day moving average. Who's to say the next go-round it's not the 200-day? You know, are we in the beginnings, and it may sound out of touch to say this on a day where the stock market's making all-time highs, but are we beginning to see a market top? Are we beginning to see the beginnings of a market top? The reason I say that is, and I'm not positioned that way, but the reason I say that is stock markets tend to roll over, right? They get weaker and weaker as they go along. And you start to get less people participating, stocks. You start to get less stocks participating, less sectors. You know, are we losing some momentum? You know, before it couldn't even go below the 50-day moving average. Then it went to the 100. What if it goes to the 200 next time, and then pretty soon you're making lower highs? Just start thinking about that going forward, because this market isn't a fresh new bull market. Now, again, I don't see any signs necessarily that it's going to happen, but start thinking about that. Keep taking your weak positions, getting them out, staying with what's working. And what's working right now in two areas that we've owned for a while have been technology and healthcare. Those areas have continued to work. The areas that are working in the last 24 hours now are very sensitive things to interest rates. Home builders, REITs, utility stocks. Those are all things that got really hit hard over the last, few weeks. And so they bounced today. Now, had we seen them bounce on their own and that's it, perhaps we'd be concerned. But the fact that everything participated, like industrials, technology, transports, materials, oil and gas, exploration, you name it, it was very broad. We had almost a 90% upside volume today. So that means we had like 87%, 86%. It was a very strong day. Not surprising, but think about that. We had, the markets weren't doing anything until 1 o'clock. So a lot of that happened in the last 2 hours. So we had well over 90% in the last 2 hours. I would also say that if we follow this up tomorrow with the same type of action, meaning 85+% on the upside of the volume, you might look for this rally to continue And the reason why is because it would look very similar to what happened January 1st and 2nd of this year. Remember the sequestration? Remember I was joking around about having the C-SPAN app on my phone, which I'd never downloaded in my life, but I was listening to these guys go back and forth about what they're going to do about sequestration and the fiscal cliff, and then they strike this deal at the last minute, and the market opens up really strongly on January 2nd. Obviously, January 1st, New Year's was a holiday. January 2nd opens up strong, follows it with a really strong day on the 3rd, and then that was it. It was off to the races. Never looked back. Perhaps today and tomorrow might be that next leg up. But we do have to look at this. We have this zigzag pattern that's been going on recently, right? And now we're at the upper end of it. So even if you're bullish, to expect it not to do this at some point and then do this, you just have to decide how cute do you want to be. We made a decision at our shop. Basically, we said, do we think the market's going to be higher or lower at the end of the year? And we said we think it's going to be higher than the point it was, in the last few days, last few weeks. And so we've been buying dips because of that fact. So we've tried not to get too cute because remember, being cute in this market, you've been penalized. Now here's the thing. I've talked to people over the last 2-3 weeks that manage billions of dollars, people that go short stocks, people that are big institutional players. And what I've been told is that it's been a tough year for a lot of people because, again, and we've talked about it on this podcast before, but if you go down the list of what has worked this year, this asset right here, the S&P 500, or let's say it another way, the stock market, the U.S. stock market, has performed great. But if you look at things like gold, if you look at treasury bonds, if you look at emerging market stocks, emerging market bonds, I could go on and on in the asset classes that have performed very poorly. And so the more spread out you were, which a lot of people were, and I'm not even going to name the institutions, but there's some very large, very smart institutions that have been wrong this year. And it's because we've had a strange bifurcated year where almost nothing worked except the S&P 500 or U.S. stocks. Now, fortunately, you live in the U.S., so what do you hear every night on the news? The Dow Jones is at 15,600. The S&P is at 1725. Most 401ks are very U.S.-based, right? So that's been very beneficial for the average American. But if you're somebody that has allocated money appropriately, meaning across a lot of different spectrums, municipal bonds and REITs and whatever it might be, it hasn't been a good year. And so what I've been focusing on is trying to make sure in my own portfolios that I have a balance of the S&P 500. We don't want to go buy things that are out of favor because they could get more out of favor. You have to have a balanced approach, but you do want to focus on the things that are working. And so I've spent the last several weeks focusing on areas that are working, even if I disagreed with them. That's the thing. There's a lot of value in certain areas. There may be value in the municipal bond area, but why would you go do that when you have something else, meaning U.S. stocks, working so well? So I've had a much more balanced approach lately and, reaping the benefits. And the stock market right now U.S. stock market has performed great. Now, don't discount emerging markets. And this is the trade that I know a lot of people had on this year. And I wasn't one of those. But there's people that were betting that the U.S. market would suffer and emerging markets would actually go up. Well, look what's happened. Emerging markets have been going down until recently, right? And, of course, I don't have to put a picture up of the U.S. You know what it's doing. It's been going up. So they've gotten both sides of that wrong. And that's why those people have been frustrated that have been kind of the long-short managers where they're short certain countries and long certain countries. They actually bet against the wrong places and put their money into the wrong places. But what's happening now is you're seeing a relative outperformance of emerging markets. And it started in July, and it really picked up in the last, I'd say, month, where you're seeing emerging markets going straight up. And this is for a couple of reasons. I think, A, there is more value there. Volatility is lower than normal there. You're seeing some improvement, marginal, in China. Now, there's a lot of people that don't believe that, but There has been improvement in China, I think, and emerging markets have turned the corner and have started to outperform the U.S. That doesn't mean you have to abandon the U.S., but what you're seeing is that's performing well. And then when you go to things like metals and mining, which had been doing very poorly, those are also starting to perk up, right? Metals and mining would include, not only gold mining stocks and things of that nature, but it would involve industrial metal mining stocks, the Freeport Mac brands, all those types of companies. And you can see going straight down, but since mid-July, going straight up and starting to outperform very good volume today. So we're seeing some risk on here. But again, overall, we have to make sure that you don't get complacent. But certainly, this was a great day if you owned equities. And in the big picture, what is the Fed doing? They're doing what they always do. They're going to continue to keep their pedal to the metal. Why are they doing it? Why is Bernanke doing this? Maybe I could not be a conspiracy theorist, but basically look and say, does he want to make sure that he's far removed from this if we ever go back into recession? So he's going to really put the juice on before he goes out the door to make sure we're not going to go back. But the thing is, how effective is quantitative easing? That's the thing that most people are missing. I don't think it's very effective. We don't think in our office it's very effective. We think it's a placebo at this point. Was it needed maybe during the financial crisis? Maybe, maybe not. But at this point, we don't think it's doing anything. And so because of that, markets are reacting to what they're saying, what they're doing. But we've talked about it before. A lot of this money that they're buying of these bonds is not making its way into the economy at all. But I can tell you this. I have a lot of friends that own their own businesses. And I don't know one that is struggling right now. Not one. They're all doing extremely well. I have one friend that is looking to potentially sell his business. He has 37 private equity firms that he's in contact with right now. 37 private equity firms. Private equity firms have a ton of cash and they're looking to make deals, and there are plenty of good companies that are doing really well. And I'll probably over the next few podcasts bring some of those people on and potentially have an interview so you can hear kind of boots on the ground what's really going on. And that's the thing. We're not you don't see those in the headline numbers all the time. And so there are some good things going on, but it's not because the Fed's keeping interest rates or trying to keep interest rates low. By doing this, that money's not going into the economy. But it does have a psychological effect like, well, they're not going away. They're going to keep buying bonds, and so I don't worry about interest rates going up. That's what they want you to believe, and so hence the stock market does rise. So that's really about it for today. Like I said, overall good day, and again, we need to see more follow through. But don't forget, it did break through this technical area right here, which is the old high, and that's the part right here when it was bouncing off this 100-day moving average. A lot of people said the market's seen its highs for this year. And only about 7 or 8 days later are we making new highs. Again, be nimble. If you have something that feels stretched, sell it. I sold a business development company about a week ago and rotated that money into an aerospace and defense company that was much cheaper and had a nice technical pattern. And that's what you have to do in this market is don't be afraid to take profits and rotate them. But again, having cash, you've been penalized for. But let's watch. Let's see over the next few days to make sure this is sustainable, because what's happening is you will hear some scuttlebutt about, boy, the Fed must really be worried about the economy. And if you start to get some bad economic data, that's when the market could struggle. But as the hedge fund manager David Tepper said several months ago, over a year ago, if the market's doing poorly, the Fed or the economy, the Fed will come in and try to save the day and try to support it, and the market will like that. If the Fed isn't in the way and the economy is doing great, the market will like that. So it's still a buy equities market overall. What we're looking for, though, is that's a lot of philosophical talk. What we're looking for is there any breakdown going on? And remember, during the early part of August, which August stocks fell about 4%, during that time, we saw a lot of stocks, the IBMs of the world. Remember we were showing the picture how they were falling? Look how they've turned the corner now. McDonald's, those types of companies, look how they've gone up. Now, they're not in a new uptrend, but they are moving back the other direction. How about Exxon? Remember how many days they were down in a row back in here? And now they're working their way higher a little bit. So, again, we need to see that leadership come back. But what we're looking for is any deterioration, and it's not there yet. We saw during this sell-off, what we saw is a lack of intensity on the buying side. Nobody was antsy to sell, but we saw a lack of buying. Now what you're seeing is some intensity on the upside here. And it was on heavier volume. So again, whether you agree or disagree with the Fed, please separate that. There are a lot of smart people in this world that comment on what the Fed should or should not be doing, different ratios, different graphs pointing to how stupid they are and what they're doing. I don't disagree with any of it, but there's a lot of fear-mongering out there, and that stuff doesn't help you make money. And so, again, I've said this before, we can discuss those things over a cup of coffee, and it's interesting to talk about, but at the end of the day, that stuff doesn't always correlate with the stock market. And it's a perfect example. What the Fed's doing is reckless. However, we're making money in the meantime. And I think that's a sad commentary, but it's the truth. And so what we got to do is trade the market we're given, not the one we want. And so, again, we can disagree with the Fed and make money at the same time. Welcome to America. All right, have a great day. Hey, don't forget, send the questions to me. We put it up on the screen where to send those, carl@eggerscapital.com. Hey, we're on Facebook, Twitter. We're on Google+, iTunes, all over the place. So thanks a lot, and we'll talk to you soon.